Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is swing trading, which is buying stocks that are going up rapidly and trying to take advantage of that momentum. And there's actually a technical tool commonly used on charts by chart-oriented traders known as a Fibonacci. We're going to be talking about swing trading using Fibonacci's. We're going to be talking about some key levels and identifying entry and exit signals. A lot to cover. Before we can get to any of that, though, let me first of all say hello to everybody out there who's already joining us out there in YouTube land. Great to see Austin and Will, Kevin and Andrew, Tatiana, see ya, Life in the Fast Lane. Josh, hello there, and John and everybody else. Thanks for joining us week after week in these presentations. We always do appreciate your attendance and your contributions here. If you are here for the very first time, kind of like I am, I'm actually filling in today for the swing trading presentation. But if you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation, but be aware that you're invited to join us in the live discussion for the swing trading series. This is a Tuesday webcast series, and we kick it off promptly 3 o'clock Eastern every week. We'd love to have you here. We also have my very good friend Barb Armstrong joining the live audience in the chats. Barb's going to be addressing any questions that I can't get to just during the flow of the presentation. Barb actually just wrapped up a webcast all about technical analysis, so we know that Barb brings a wealth of knowledge and experience to this discussion. I was her chat support for that webcast. She's mine for this one. Thanks for having my back there, Barb. And Barb and I would like to issue an invitation to everybody within the sound of my voice. If you have an account with X, give us a follow there. You should be following your favorite presenters there. Your favorite Schwab presenters. You can find Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS, but it is the best place to connect with your favorite presenters in between these live stream events. But let's get into this. And as we go to discussing using charts to swing trade stocks, of course, that carries risk. So we need to bear in mind these important disclosures. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's talk about what we're going to talk about. Let's set an agenda for today's discussion. I want to start things off by reviewing current market conditions, but I'm going to be doing it through a specific technical lens. So we're going to be using this tool on charts known as Fibonacci's. Now, I was kind of wondering whether I was going to talk about this or not before the webcast started, but if you were paying attention just a few hours ago, another one of our coaches talked about doing much shorter term trades using this tool. So, yeah, if you attended Mike Fairborn's webcast, he may have provided an introduction to this tool if you weren't familiar with it already. But I wanted to extend that to a much longer term view of what's going on with the markets, and then we're going to narrow it in further, always using the same tool. But that might give us an interesting view of what's going on with the S&P 500. And that's going to set the stage for our discussion of swing trading individual stocks using that tool, the Fibonacci tool. So we're going to be talking about how it might identify potentially important reversal levels for stocks and how those levels might be used to generate entry and exit signals. And we're going to wrap this all up with a bow by illustrating how to plan and place an example swing trade. So Greg, you didn't catch that? That's okay. I'm going to be going at a pace. I never assume that anybody knows everything that I have wrapped up in my head for the discussion. So I'm going to make sure that I set the table completely for what Fibonacci levels are, even from where they're generated from. Then we'll get into their application, and then we'll use specific trade execution as an example. Okay, so let's go right to the markets. We're using the Thinkorswim desktop trading software platform, and this is a 3-year view of the S&P 500. Does anybody remember those days when the stock market was going up? That was fun, right? We were just going up, and it was started right back here, October of 2022. The market started gaining some momentum, and rose and rose and rose and rose and rose until we hit the peak through the 3 weeks into February, and then we sold off. And we sold off hard. Now, there's something interesting. Greg, it was fun, right? For the bulls, at least. Something interesting about how far we have sold off, at least so far, down to these lows. For some traders, when they see a strong advance over whatever period of time on whatever chart, whether it's an index or a stock, when there's a strong advance or actually a strong decline, but a strong move in one direction or the other, there are some assumptions about the proportions of counter moves that may develop. So in this case, we had a very strong move over a fairly extended period of time on the S&P 500 where it ran up. Well, we've actually pulled back and surrendered down to these lows almost exactly 50% of this climb. I'm going to use our Fibonacci tool here, and we're going to start to illustrate this. So I'm going to go down here. If we let's say we had some other active tool, maybe we were using our trend line tool. Let's select the Fibonacci retracements tool, which is the big percentage icon. And I'm going to go to the top of this up move. And yes, the order in which we execute the drawing clicks is important. So in the case of an upswing, I'm going to go to the top of that upswing and click once. And this is starting to draw in some lines here. And as I move down to the bottom of the upswing, those lines are fanning out, following me down. And then once I've reached down to the bottom of that up move, I'm going to click again. And so what this is doing is it's giving us a starting point, the 0 line, up to 100% of the move, the top. That's our end point. And then if we look at how far we've descended from that top, we came right down, and on that weekly low, just about 50%. Okay? So this is, for some of you, maybe the very first time you've ever seen somebody use a Fibonacci extension tool like this. But what you'll notice is there are a series of lines here, and there are actually some more up above the chart I'll talk about in just a moment. But I want to talk about where these numbers come from. So let's open up the left column. And all of these are generated using ratios from what's called a Fibonacci series. It's a number series. So sorry, we're going to go to math class for just a moment. But fortunately, it's not terribly complicated, at least in my estimation. But the Fibonacci sequence of numbers starts with the number 0. And then we proceed to the number 1. And then we just start adding those together. So 0 plus 1 is 1. And then from here, we just take the last two numbers in the sequence to calculate the next number in the sequence. And then it's just a lather, rinse, repeat. So 0 plus 1 is 1. 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5, 3 plus 5 is 8, 5 plus 8 is 13, let's just keep going, 21, 34, 55, kind of doing these quickly, 89, if I make a mistake, but on and on that sequence goes ad infinitum. So that is what's known as the Fibonacci sequence, and that's how it's calculated. Well, in some of the harder sciences, in mathematics and biology in particular, but in lots of other sciences, there's been some significant weight assigned to the relationship of these numbers, one with another. And in particular, there's one comparison of two numbers in the sequence. What we do is we take one number and divide it by the next. So let's do that. Let's take 55 as our example, divide it by 89. It's just a number to the right in the sequence. And it gives us this outcome, 0.618. I'm doing a little bit of rounding, so I don't have to put in all the decimal points. But this is known as the golden, not Galden, golden ratio. 0.618. Now, if we reverse that order, we'd also get 1.618, which is also a variation on the golden ratio. But that relationship has been found to have all sorts of important applications in math, in biology. It describes all sorts of things, including the creation of a spiral. I'm not going to go too far into that. I think that's getting a little bit too far afield. But you'll notice, as we look at the 0.618, we're starting to fill in some of the gaps here. We already know what 0 is. We already know what 50% is. And we already know what 100 is. Those three are actually not technically, even though they're part of our Fibonacci drawing tool. They're not technically part of the Fibonacci sequence, or Fibonacci. They're not considered Fibonacci numbers. But the rest of these are, and you'll notice 0.618. Hey, there it is. We've just moved the decimal 2 spots to the right. Yeah, see ya? The sunflower sequence in nature, the way that sunflower seeds are arranged, they're actually arranged in sort of a spiral, and it's kind of a double spiral. That's just turns out that that's the most efficient way to pack in as many seeds into a circle, like a sunflower. But there are some other ratios that we need to consider, and really all we do is, instead of taking a number and dividing it by the number immediately to its right, you take a number and divide it by the number that's 2 increments, or 2 numbers to the right. So for example, if we take 34 and divide that by 89, that gives us 0.382. So let's jot that down here. And what do you see right there? 38.2. And by the way, in just a moment, there's going to be a big bonus question. This one's going to earn you a gold star if you know the answer to this one. But let's do this once more. Let's go with 21 and go 3 increments over to the right. So 21 divided by 89 gives us another ratio of 0.236. What do you see right there? 23.6. So that's where these are coming from. And what trading has done is it's leaned a little bit into the harder sciences. I say harder because, yep, trading, does it involve a lot of speculation, a lot of assumptions? It certainly does, yep. But what some traders have noticed is that these ratios may actually have application in the planning and placing of trades as well. So we know now 0, 23.6, 38.2, the 50, 61.8, the 100. I said there was going to be a gold star. Where in the world does this 78.6 come from? Who can tell me that one? That one's, it's the one that requires the most steps. And for some traders, that conceptually can undermine its anticipated strength. It's not one of the purer ratios. It's actually an extrapolation of a ratio. The way that's calculated is we take the golden ratio, 0.618, and we get its square root. Look at that, 0.786. So how about we just squeeze it in here? Actually, we could put it right up at the top to keep it in sequence with the way it's displayed on our chart. But there we go. That's where these numbers are coming from. Now we understand where they're from. Let's talk about how they might be used and why they might be used in the way that they are used. Oh, and by the way, thank you, Wiley, for calling this out. I think, did somebody else do this? But there is a survey link in the chat window for the live stream audience. So if you do me this favor, as we get deeper into this discussion for planning swing trades using Fibonacci's, click on that survey link and have that ready so you can fill it out when the webcast is over. You can give me some honest feedback. Here's what I'll tell you about the surveys. They're very short, 2 multiple choice questions, and then there's a comments box and a suggestion box. And I'll make a promise to you, if you take time to fill out that survey, I take the time to read through the data provided by your answers and the comments there, and it helps. It never just, you might feel like whenever you're filling out a survey, is the right person ever going to see this thing? Yeah, the right person definitely sees these. They provide that information right to the coaches, and it helps, okay? So thank you. But Anoop says, can't we draw a fib from the top to the bottom at 48.19? Good question, Anoop. Very good question, and yes, I'm going to. But let's just talk about this sort of the sort of psychological or logical underpinnings of why traders care about these levels. So here's a basic assumption, and that is when a trader sees a stock or an index go rocketing up for any period of time, they expect eventually some profits are going to be taken there. There's an ebb and a flow to the markets. And historically, some traders think they've identified some proportionality to the ebb and the flow. So when there's a very strong move to the upside, a common assumption is that when the selling starts, it might take us back as much as half of the distance that was gained, in this case, bullishly to the upside. Now, for a trader who's planning to use that to execute a bullish trade, if it starts to go beyond 50%, that starts to put an asterisk, a question mark on the pullback, because it might be considered normal for some profit taking. Lots of people made a lot of money in a comparatively short period of time. We can forgive them for starting to take some of the profits off the table. However, if it starts to go beyond that 50% level, a trader might go, wait a second, maybe there's something bigger going on here. It's not just profit taking. It's not sometimes you hear this phrase, the weak hands leaving the markets, meaning the ones that were looking to take profits at the first opportunity. But could this now be more panic selling? Could it be enough to completely reverse all the progress that was made on the initial upswing? So that 50% level becomes key. So for now, what we see here is that we've pulled down and we've touched that 50 and started to come back up. Now, Anoop, let's go a little bit shorter term and start to apply, get some repetition with this new knowledge. Let's switch up our time frame to a 1-year chart. I'm going to remove this longer term stuff. Let's right click on our drawing, just remove it. But what Anoop had proposed and what I definitely had planned to discuss was this now downswing. I wonder if these proportions can apply to this move. Now, when there's a downward move, we reverse the way that we draw. So instead of going to the top of the up move and draw downward, in a downward move, we go to the bottom. I'm going to click down here and draw upward. That has the start up here at the top, 0 up at the top, and 100% is now at the bottom. But what we'll notice is when we sold off, with all of this selling that we've accomplished, look what happened right in the middle. At that 50% mark, we found some support. It looked like maybe we were starting to go higher, but we broke down through that again. And it's interesting how that has become a potentially intermediate to short-term important area of support and resistance, price floor and price ceiling. So on the rebound here, if we look at the full sell-off, how high did the recovery take us before it started to struggle? Right at about that 50% level. So the proportions are still bearing out again. That's interesting. Does it guarantee how the S&P 500 is going to perform? No, not necessarily. But for a technical trader, they might see this as just confirming where they might have thought we'd get a reversal on this bullish bounce. Now, Anoop, I'm going to go one level deeper here now, because we've had a strong move up, we've had a strong move down. But do you think anybody would classify just over these last couple of weeks, especially this low that we hit here on April 7th, up to that high just a couple of trading days later, is that a strong move? The S&P going up, what did it go up, like 11%? Anyway, let me right click on this. I'm going to remove this drawing. And I'm going to go to the top of this up move and draw down to its bottom. And look at where the candle settled as we sold off. Our closing value right at that 50% retracement of the upswing. That's interesting. Never really got down to the next Fibonacci level, and we've started a recovery. So what some traders might do is this might at least indicate to a trader where the major reversal points are in the long term, the intermediate, and even in the short term. This could indicate that we're starting into possibly a more extended upswing. So this is interesting. Now, there are some other levels that I mentioned are on the chart that are built using Fibonacci numbers, and they're actually more even up above. If I were to click on this right margin and drag down, you're going to start to see other Fibonacci's appear. And we keep going and keep going and keep going. So we have 161.8, 261.8, 423.6. Those are all extrapolations of the Fibonacci trading sequence. Let me set this back to auto so that it adjusts that scale. Beth says, I love you, Cam, but can we move on to how this applies to swing trading, Beth? Hey, I get you. I think it's important to discuss each of these levels because our swing trader, first of all, if they're using Fibonacci's to plan a stock trade, they may first see where they sit, where they think things sit on that broader perspective using the S&P 500. Because if we go planning, let's just say we put our blinders on and we ignore what's going on with the markets, and we're just focused on a stock, is it possible we might decide, oh, this stock should be bullish, but at the same moment on our index chart, maybe we're hitting resistance on Fibonacci's in an important way. Maybe, and we'll talk about resistance levels in just a moment. But yeah, I wanted to provide that broader context that so many traders use before they go to the individual stocks. Okay, but yeah, let's get to that. It is time to go. So let's have a look at a stock that's been doing something maybe technically interesting recently. Here's John Deere. So what's happened with John Deere recently? Well, it's had a recent history. When it gets down to just above $400, it went shooting up. And then it came back down to, look at this, got all the way up to $500, came back down just above $400 again, and then shot up again. It went from a low of 404 up to a high in just a few days of 473. It's 473, pretty close to a $70 move. Now on a $40 stock, what is that? That's close to 20%. That is a very rapid move in a very short period of time. And it's just the sort of move that Fibonacci traders might look for to start to structure a swing trade. What they're looking for is a stock that has a demonstrated history of big moves in one direction or the other. And we're going to be trading bullishly today, just doing traditional long stock positions. So we're looking for a big upswing. And then they'll use their Fibonacci's to gauge the proportions and help them maybe identify entry signals using key levels and exit signals using these key Fibonacci levels. So on a big upswing, let's zoom in on this. We're just going to focus on, actually, might need a little bit of historical context here. Let's maybe get this much. That'll work. All right, but there's our big upswing. So big upswing, let's plan a swing trade. So on a bullish trade, we go to the top. And notice this is one of the reasons why I like the little crosshairs on my pointer, because I don't have to be exactly at the top of this candle. I can just get my crosshair line to sit on top of that candle, and that'll work. Just click there, move down to the bottom of the lower candle, and click again. And on this strong move, the first thing that the trader might be waiting for is a counter move. And a common assumption is, yeah, we might get down to 50. Sometimes we go a little bit further. Other times we come up a little bit short. So one common range of potential entries, this is, I've seen this a number of times. Not every trader sees it this way, but really just getting between the 61.8 and the 50% retracement level, that might be good enough for some traders. They don't even need to see prices start going up again. Just the mere fact that the selling has taken us back down between 61.8 and 50, if we want to say it a different way, if we've sold off about a third to about a half of the original distance, that may be time to take an entry. And you can see whether we did that up here or we did it down here, so far not turning out to be too bad of an entry. Tatiana says, can you plan a trade when an earnings is coming up? I think, Tatiana, is the question you're asking. That's a great question. Technical analysis can be performed in advance of an earnings, but it doesn't actually provide any insight into the real numbers that are going to be revealed by that company, nor is it going to give any insight into the projections for future earnings and sales and everything else that's discussed in the announcement, nor does it give us any insight into how the market's going to respond to whatever is revealed there. So No, technical analysis usually doesn't provide great insight into an earnings announcement. Okay, so good question. All right, anyway, yeah, just the mere fact of price dropping down below 61.8 and that 50% level for some might be adequate. For others, though, they may actually prefer to see prices start to strengthen at least at or above the 50% level. So in this case, we've started to do that already. So maybe a trader might have had a preference to get in yesterday. Another trader might be okay with entering today, and that's what we're going to be doing. So there is one key level. Getting between the 61.8 and the 50 is a possible signal for entry, maybe waiting for a white candle the next day. But now let's talk about the really fun side of the trade. Well, where might we plan to take profits? Well, the 78.6 level, as I've discussed, it's a square root of a ratio. Okay, maybe that has strong application in mathematics, maybe for biology, but for some traders, just this obscurity of it can undermine its potential application for some. Now, Thea says, is this a dead cat bounce? That's a possibility, okay? Yeah, a dead cat bounce is, well, actually, no, Thea, I would not say that this is a dead cat bounce, because a dead cat bounce happens after a strong move downward. Now, if you're just talking about these few candles, that's a possibility, but this is actually a reversal after an up move. So if we're looking at this, just this element, possibly a dead cat. But another thing about a dead cat bounce is it would be in a downward trending stock, and this one actually would have a higher low here, so not downtrending. Anyway, so where might the trader make an initial plan to harvest profits if the profits start to realize themselves? Well, a common assumption is that once these sellers, once the profit taking has ended, if the enthusiasm for whatever it was that got traders so excited to drive the stock up close to 20% in the first place, if there's even a whiff of that left, hopefully that can drive us just back up to where the stock was before. So that looks like that might be around 473, and it's okay. We might do some rounding here, but let's make a plan here. And let's say a potential target, I'm going to call this target number 1, sometimes abbreviated to T1, might be that 473 level. All right. For some other traders, though, that's not sufficient. If they're more aggressive, and this is very typical application of a Fibonacci, what they see is something got traders excited. There was some profit taking, and if that excitement remains, maybe we can get another move proportionate to the first one. So that brings into play this 161.8 level. That 161.8, how is that generated? Well, pretty straightforward. All it does is assumes that we're starting another move once we cross that 61.8 line, and then if we get a proportionate move to the first one, in other words, if we previously moved from this low up to this high, let me just right-click on that drawing, and let's activate that drawing, and I'm just going to move this over here and tack it on right at that 61.8 level. Where does that take us? That takes us to the 161.8 level. So for our trader who was waiting on an entry down near 50, if we can get back up above 161.8, the stock has momentum here. We get a new move equal to the original. That's where it takes us. I think it's interesting with this one that also coincides. Look at how neatly that lines up with previous highs right there. I don't know if I drew that perfectly straight, but close enough. Yeah. So when there's an aggregation of technical evidence for a specific price, that might give the trader a little bit more confidence. Does that mean we're absolutely going there? Of course it doesn't. Nothing's a guarantee here, but that's another way that a trader might plan a target. So we might call that target, not target, target number 2. Now, I'm in a minute going to propose some other levels that might be used, but that target would be around $515. I know it says $515 and 21 cents, but in the grand scheme of things, the 21 cents, it's an estimation, it's an approximation that 21 cents is mathematically not terribly significant. Anyway, so all this is to plan a trade if it's going well, and that's a big part of swing trading. The definition of swing trading is that we buy a stock with a plan to take profits at a specific price level. We think the stock is swinging up to a specific price level, and we predefine that in advance and make a plan to sell right at that level. So that's a swing trade. If we don't have a plan, if we're just buying because we think the stock's going to go up, we don't know how far, and we're just going to hang on to it and let it go, that's actually known as a trend trade. It's a totally recognized, just different type of trading, but we're doing swing trading here. Now, is it possible that we've gone to all this trouble? We studied the Fibonacci levels on the long term on the S&P 500. We studied the Fibonacci's on the intermediate term on the S&P 500. We studied the Fibonacci levels on the short term on the S&P. We studied the Fibonacci levels on our John Deere potential position. And after all that work, the stock has a mind of its own and goes the other direction. That's a possibility. So the trader typically in a swing trade has a plan for if the trade fails. Now, it's possible we might come back down to that 61.8, that the profit taking just hasn't ended yet, and we were a little bit early. Could even get down to 50, and we'd still be within the traditional tolerance of a Fibonacci approach, that it's just profit taking still, not time to panic. However, if we get down here and touch that 38.2 level, now the proportions are starting to get a little bit wacky. It was supposed to be just some profit taking, not wholesale selling. So for traders using Fibonacci's, quite commonly they draw the line in the sand right there at 38.2. Let's call that the $430 level. We're going to have a stop down there. Now, not every trader puts it right at the 38. They might go a little bit below to give a little bit more wiggle room. And as a matter of fact, with my rounding, that's exactly what I've done. I've gone about 73 cents below the really hard number of 430.73. But you'll also notice I kind of popped in that Fibonacci high, and I kind of popped in that Fibonacci low. There's a chance that I was off by pennies anyway. Okay, so eVentures says, what proportion of your shares should we sell at that first target? What proportion should we sell at the second target? Up to the trader. Some traders might be perfectly happy taking all the profits off the table right there, because that becomes sort of the bird in the hand scenario, whereas this is still not a highly probable outcome to get back up to those highs, even if we think it is, even if it looks like it should according to our tool analysis here. So some might take off the entire position. Some might take off a specific predetermined proportion, like let's say 50%. Or others might retain the entire position and say, I don't know what you guys are doing. I think we're going to get another move that just like we did the first time, and we're going on up to 515. They hold on for the whole thing. So definitely up to the individual trader. But this is starting to become a swing trade plan where we know when we're entering, where we're taking profits, and where we're trying to stem those losses. Now, before I go place the trade, I want to recognize that, does anybody look at this and think, okay, so are we really only given the choice of having a relatively small gain or a relatively enormous gain, and that's it? Nope, for some traders, they actually will customize these Fibonacci's, but in adherence with the traditional Fibonacci ratio sequence. So that's not the right way to put it. The traditional Fibonacci ratios. So I'm going to do this. Let me take off this drawing. And I'm going to right click on the Fibonacci that we've used. I'm going to right click here and edit its properties. Now, we have the 161.8 up here. And actually, before we edit it, let's just go back here and just look at the other ones. For some traders who really thinks this stock is going to get a tailwind behind it, and maybe it starts to move through significantly higher highs and higher lows, they may use these higher Fibonacci's for far more distant targets. But come on, look at this. With the stock trading at $454, if we say, let's use the most aggressive Fibonacci and say we're going to sell if we get to $694, that's literally $240 away. That's more than a 50% increase in the price of the stock. Could that happen? Yes. Is it likely? Not even close to likely. So for some, they may see these larger Fibonacci's as having limited application for the planning of a swing trade. So why not just adapt that? So I'm going to come here. Let's choose the auto again. That just adjusts our right margin spacing again. I'm going to right click on our fib and edit its properties. The default properties are to use the traditional ratios and then these extensions of the traditional ratios. Well, I'm going to click on this one and I'm going to change it to being, instead of 1.618 way up here, let's do 1.236. And on the next one, instead of using 2.618, let's do 1.382. And then finally, here comes that 1.618 again. So we've just modified our, these are called curves, by the way, even though they're not curved. In some types of Fibonacci's, they are curves. Anyway, let's click OK. And as a matter of fact, we could save this so all future Fibonacci's that we draw, instead of drawing these really high extensions way above price or way below price in the case of bearish trades, it'll draw them more conservatively. So let's just click OK. And you see what that just did? That gives us some intermediate target levels between the 100 and the 161.8. And with John Deere, once again, that's kind of interesting. This one goes right back to this high. So a little additional technical evidence there. This one goes right back to this pair of highs. A little bit, well, right at one, a little bit below the other one. So this could change the way, for some traders, they might say, you know what, I wouldn't quite be satisfied with that first one. I think that second one's a little bit unrealistic. Maybe if I can just get up to this first peak, maybe 489. Greg says, can we make that modification the default? Yep, Greg. Like I mentioned, once you've made a change, if you've edited those properties, if you click right here where it says save as default, you don't have to do that anymore. That'll be what your Fibonacci's are from here forward. I'm not going to do that. Let's just leave this on just this one Fibonacci. But how about, let's split the difference on our example swing trade here. Let's maybe say we're going to go not just for this 100 level, but let's go up to that first extension of our more conservative, our most conservative ratio, the 123.6, that'd be $489. And I'm just going to take the entire profit at that point, okay? So let's go put this trade plan into practice. We're not going to use a second target on this one. We'll just buy with a plan to take profits, either if we get up to 489 or if we slip down here to 430. So we're going to go to our trade tab, right click on our ask price, and let's put in a custom buy order with an OCO bracket. 2 sell orders, but one of those sell orders is going to cancel the other one. And our stock costs $454. Let's just say we're doing 10 shares on this. That'll be a $4,500-ish trade. And let's click on the little broken chain link, our, oh, I started too soon. There we go. All right. Anyway, just make sure the quantities are all 10. Then we can use a market order to get immediately into this trade, or at least improve the odds of getting in immediately. Markets are open. I could do this. I'm trying to decide if I actually want, I'm just filling in today, so I won't be following up on this trade in a future webcast. But we could also set a limit. How about for this trade, we just use a market order? But this limit order is for our target. And our target was going to be 489, right? That was that initial Fibonacci extension And I'm going to make sure that's a good till canceled order. And then our stop was down at 430. There we go. Well, actually not there we go. Let me redo that with that left window collapse so that we know we have the right prices there. And let's make sure that's a good till cancel order. Now, a trader, if the ratio of reward to risk is important to the trader, and that's very common with swing trading, they could do some quick math here. Let's assume we buy right at about $454, and our plan is to sell at $489. What does that give us? It gives us about a $35 profit potential. Our stop is down at $430. That gives us about a $24 loss potential. So we're just about $1.50 of reward to each dollar of risk, pretty close. So it really depends on where the trader draws their line in the sand. Some want to make sure they have at least $1 of reward for every dollar of risk. Others may say, I need at least $2 of reward for every dollar of risk. This one would not meet that criteria. But I'm going to say we're okay with this trade, and we just click confirm and send. So we're buying 10 shares of John Deere at current market price, wherever that fills. Going to sell those if we can get to that 489, or sell if the selling continues. If we go on down to 430, that trade's over. And a couple of quick reminders here before we would submit this. With market orders, prices can change quickly in fast market conditions, and the prices are climbing, resulting in execution prices that can be different from the quotes displayed at order entry. And with stop orders, like our $430 stop order, there's no guarantee that the execution price, if the stop is triggered and filled, that execution price can be different. There's no guarantee that it'll be equal to or near the activation price. In this case, that'd be our 430. So we could just send that order off, and that would complete our trade. But that does, I'm not going to submit it, but it does accomplish what I wanted to talk about today. I wanted to talk us through what Fibonacci's are and how they might be planned or might be used to plan swing trading for stock positions. We talked about key levels. We talked about entry and exit signals. We even modified some of those key levels using the logic of the Fibonacci ratios. So we're consistent with our logic in those modifications. So I hope you enjoyed this presentation. If you enjoy this sort of a topic, swing trading, we meet every Tuesday. Yep, typically not me, but every Tuesday at 3, is that right? 3 Eastern? Yep, that's when this webcast is delivered. You're definitely invited to join us in the live webcast, but I'm going to let you go. But as I do, some reminders about the resources that you have at your disposal. Number one, make sure that you're subscribed to our Trader Talks channel. And there is something cool on our Trader Talks. We just added YouTube Shorts. So if you haven't subscribed to the Trader Talks channel, just go down and click on the subscribe button below the video stream right now. But this is where you can find our playlists of previous webcasts. You can join the live streams, and you can now see YouTube Shorts about trading-related topics. For example, one that was just published is how to utilize the proprietary market forecast tool on Thinkorswim desktop. Nice little video here put together by Brett Crowther. It's only 2 or 3 minutes long, and even better, he gives a shout out to me. Yeah, actually, I did a longer video, a 45-minute video on using that market forecast tool. So if you want to learn more about that, you can watch that short and then watch the video that Brett talks about within that short. But yeah, that's a kind of a cool new feature that we just added. Also, if you have an account with X, make sure that you're following your favorite presenters there. You can find Barb on X at Barb Armstrong CS. You can find me on X. Let me show it to you because I think seeing it is more meaningful. There is my handle on X at Cameron May CS. Be precise with these handles because there can be similar handles, then you're following the wrong person. Don't want to do that. At Cameron May CS, but that's the best place to connect with your favorite presenters in between these live streams. And also, make sure that you fill out that survey if you would. That would be fabulous. You now have everything that I have to offer. You can give me some honest feedback. That's definitely appreciated. I'll read through those comments and I'll read through that survey data, so it always helps. Thank you, everybody that's already clicked the thumbs up for this webcast. I can see, now 51 people have already clicked the like button. That's always appreciated. It also gives my webcast a boost in the YouTube algorithm. So when you watch a webcast and you enjoy a webcast, make sure you click the like button before you go. But everybody, go enjoy the rest of your day. I will see you in my regularly scheduled webcast tomorrow. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.